Hello, I am Cem Özey. Welcome to the weekly market notes program. This week, the market's agenda was quite busy. We will discuss the reasons behind the sharp sell-off in global markets, the record Nvidia earnings that came amidst this wave and reignited the tech wind, the latest economic data from the US and Europe, and the critical levels in commodities and crypto markets. Then, turning our focus to Turkey, we will analyze the Borsa Istanbul, which has diverged positively from global turmoil, the trend of the US dollar, TRY, and the risk premium dynamics. Finally, we will conclude our program with the economic calendar that will shape next week's markets. This week, we witnessed a true crossroads in the markets. On one side, there were sharp weekly declines in technology stocks and crypto assets driven by macroeconomic concerns and interest rate uncertainties. On the other side, amidst all this negative sentiment, came Nvidia's record-breaking earnings report, reigniting the artificial intelligence narrative. Understanding these two opposite dynamics is crucial for investors to determine their strategy in the upcoming period. Let's present the week's contradiction with clear numbers. The Nasdaq 100 index, which tracks technology stocks, closed the week with approximately a 2% loss. Bitcoin, at the extreme end of risk appetite, fell over 11% weekly, dropping to around $84,600. Amidst this storm, Nvidia announced a record profit of $57 billion in the third quarter and raised its profit forecast for the next quarter to $65 billion. So, what do these conflicting signals mean for the global markets? Let's take a closer look. Analyzing the two main forces shaping global risk appetite, the US economy and signals from Europe, is essential to understanding the current market climate. In particular, the gap between employment and inflation data that influence the policies of the US Federal Reserve, Fed, and market expectations plays a critical role in investor decisions. Looking at the latest data from the US, we see a mixed picture. The non-farm payrolls increase for September was expected to be 51,000, but came in much stronger at 119,000. However, the same report showed the unemployment rate rising from 4.3% to 4.4%. This indicates an increase in labor force participation, but the number of people finding jobs is not growing at the same pace. Despite these mixed signals, following statements by New York Fed President Williams on Friday, the market began to price in a greater than 70% chance of a rate cut in December. Another reason for the volatility experienced in the market is seen as a temporary liquidity crunch. Behind this are factors such as continued monetary tightening, cash accumulation in the Treasury's account, and uncertainty in interest rates. On the European front, the data paints a more positive picture. The Eurozone's composite PMI remained at 52.4 in November, indicating growth. The services PMI also maintained a strong trend at 53.1. However, the decline of Germany's PMI from 53.9 to 52.1 signals a slowdown, while France's increase to 50.8 indicates a slight expansion. At this point, to understand the bigger picture behind the data, a complete mind game is happening in the market. While Fed officials continue to speak hawkishly on one side, the market almost certainly expects interest rate cuts on the other. In this environment, the record profits of companies like Nvidia reignite the debate. Is there an artificial intelligence bubble? Let's not forget that, according to a report, the increase in market value of artificial intelligence companies has reached $19 trillion, while their actual contribution to economic productivity is currently around $8 trillion. This gap could be the main source of volatility in the coming period. Now let's move on to the analysis of the S&P 500 to see how this global macro picture is reflected in the US indices. Analyzing the current technical levels of the S&P 500 index, which best reflects the overall health of the US stock market, is a fundamental indicator for understanding investor risk perception and the general market direction. Despite the strong rally on Friday, let's detail why the weekly chart still depicts a cautious picture. Although the S&P 500 index recorded a strong increase of 0.98% on Friday, this jump was not enough to save the week, and the index closed with a decline of more than 1% for the week. From a technical perspective, the most critical support level is in the range of 6,490 to 6,512 points. This area represents previous peak and trough levels from October and is essentially the last stand for the bulls. Maintaining this level is vital for the continuation of the upward trend. On the upside, the nearest resistance and pivot level is in the range of 6,680, 6,700 points. For the index to ease selling pressure, it needs to regain this zone. Let's also quickly review some striking macroeconomic data that support this technical picture of the S&P 500. The total market value of US companies has reached $68 trillion. The second-ranked China has a total market value of only $13 trillion. This shows the huge gap between them. Nvidia's weight alone in the S&P 500 index has reached approximately 8%. Lastly, housing costs, which make up about 40% of the US CPI basket, are one of the most important items to monitor for future inflation. After the overall picture of the S&P 500, let's examine the situation of the Nasdaq 100 index, which is more sensitive to interest rates and keeps a close eye on tech giants. The Nasdaq 100 index, which is the barometer of technology and growth stocks, is the market that reacts the fastest to interest rate expectations and mega trends like artificial intelligence. This week, let's analyze why the index has been more negatively divergent than other indices and how Nvidia's impact is trying to balance this picture. The Nasdaq 100 index closed the week with approximately a 2% loss, showing weaker performance compared to the S&P 500 and Dow Jones. The critical psychological support level for the index is in the 23,841, 24,000 point range. A weekly close below this level could further accelerate selling pressure. For a short-term relief rally, the pivot resistance in the 25,000, 25,250 point range needs to be surpassed. The weakness in Nasdaq reminds us that the technology sector is actually the most vulnerable to the Fed. However, on the other side of the coin, data such as Palantir's 123% quarterly growth in its US commercial operations indicate that the AI revolution is still in its embryonic stage and that corporate spending is necessarily shifting into this area. This battle between short-term interest rate concerns and the long-term technology revolution will determine the direction of the Nasdaq. Let's move on to the next section to examine the current state of the US bond market, which is most directly affected by interest rate expectations. The US bond market is not only a gauge of borrowing costs, but also a compass that determines the direction of global risk appetite and capital flows. The contradiction between the Fed's hawkish statements and the market's persistent expectations of interest rate cuts is putting significant pressure on bond yields. Markets are pricing in over a 70% chance of a rate cut by the Fed in December. This expectation is supported by weakening employment indicators, such as ADP data and the approaching 30-week unemployment duration, and declining inflation expectations. 10-year bond-based expectations are around 2.5%. Despite this, the 10-year US government bond yield remains above 4%. This reflects uncertainty in the market. An interesting dynamic is occurring on the buyer side. While China continues to reduce its position in US treasuries, new buyers such as stablecoins, which have reached a scale of about $30 billion, are feeling part of this gap. At this point, it must be said, the bond market is essentially telling the Fed, "I don't believe you." While Fed officials send messages that the fight against inflation is not over, the market is betting that the economy will slow down and the Fed will be forced to cut interest rates. The winner of this stubbornness will be the personal consumption expenditures (PCE) data to be announced next week. That data will show us who is right. Now, let's move on to the commodity markets, which are another reflection of risk aversion and inflation expectations, especially gold and oil. Commodity markets are the primary indicators of global economic growth, inflation expectations, and geopolitical risks. This week, let's examine why gold remains under pressure despite expectations of interest rate cuts and what the decline in oil prices signifies. Spot gold has been trading within a range of approximately $4,065 to $4,100 this week, with $4,000 serving as a strong support level and near resistance at $4,100, and the market is awaiting a new catalyst. China continues to be one of the largest buyers for strategic reasons such as preserving its reserves and developing the Shanghai Gold Exchange. This creates a floor for prices. Silver also closed the week with a sharp decline. The critical support level is at 47, with the psychological resistance at 50. In oil prices, West Texas Intermediate, WTI, fell below $60. This reflects concerns about the global slowdown, but it is a positive development that reduces inflationary pressures. To add a comment, it's interesting that gold remains so stubbornly above $4,000. Normally, expectations of interest rate cuts should benefit gold, but they haven't. This indicates that the market is not yet fully convinced by the Fed's easing signals, or that it needs a real inflation concern for gold to rise further. Without the China factor, we might have already broken below the $4,000 level. Now, let's analyze the reasons behind the sharp sell-off in the cryptocurrency markets, which are at the extreme end of risk appetite, and examine the technical levels. Crypto assets are the most sensitive asset class to global liquidity conditions and risk perception. This week, let's examine the macro dynamics behind the over 10% declines and contrast them with long-term corporate adoption news to assess whether the market is searching for a bottom. Bitcoin's price declined by over 11% on a weekly basis, falling to approximately 84,600. The critical structural support zone is between 84,000 and 85,000. If this level is lost, the decline could deepen toward the 73,000 target. This sharp drop may be the clearest reflection of the global liquidity crunch we previously mentioned. After all, the crypto ecosystem often acts as a leading indicator for such liquidity fluctuations. Ethereum's price has fallen to 2030 and is trading below the weekly pivot point of 2893. The most critical support level is 2454. Breaking this level could confirm a deep bearish trend. The price of Ripple dropped to the 1.98 level, broke below the 210 support, and the technical outlook is clearly weak. Interpreting this chart, the crypto market is experiencing a complete irony. On one hand, the US regulatory agency OCC is issuing a guide that allows banks to hold cryptocurrencies on their balance sheets, which is revolutionary news for the long term. On the other hand, the market is collapsing due to short-term macro fears and interest rate concerns. This is the battle between the narrative of institutional money coming in and the reality of hot money leaving. The $84,000 support will indicate where this battle will end. After this turbulent week in global markets, let's turn to the domestic markets to analyze how Turkish assets have performed. Let's analyze the three main indicators that gauge the pulse of the Turkish economy: capital flows, risk premium, CDS, and confidence in macroeconomic policies. Let's evaluate why Turkey is diverging positively despite global fluctuations and what factors influence the sustainability of this divergence. Foreign portfolio flows continue their weak trend. Over the past 4 weeks, there has been a net inflow of only $0.6 billion. In fact, in the last week, the week of November 14th, there was a total foreign outflow of $1.3 billion from the bond, stock, and swap markets. Despite this, Turkey's 5-year CDS premium has decreased to 243.82 basis points, maintaining a stable trend below 250 basis points. This is the most important anchor in the market. International credit rating agency Fitch has upgraded the credit ratings of some Turkish banks, such as Vakıfbank, TSKB, and Halkbank, citing improvements in the operating environment. This is another indicator of confidence in policies. The current biggest assurance for the Turkish markets is not foreign capital inflows, but the confidence in implemented policies that has anchored the CDS premium below 250 basis points. This low-risk premium acts as a shield for Borsa Istanbul. Although hot money inflows are weak, I do not expect major panic as long as the CDS remains at these levels. An important detail is that the increase in foreign currency accounts of domestic residents is entirely due to gold. This situation reflects a global search for safe havens rather than a flight from the Turkish lira, and it does not create a sharp dollarization concern. However, if the CDS rises again above 270, it will change the entire game in the market. Let's move on to the next section to analyze how this macro framework is reflected in Borsa Istanbul, along with technical levels and domestic investor dynamics. Istanbul Stock Exchange achieved a positive divergence from global markets with its weekly performance. Now, let's analyze the critical technical levels to forecast the short-term direction of the index. Let's detail which levels need to be maintained for continued rise and where the potential profit-taking risks are concentrated. The BIST100 index closed on Friday, November 21st at 10,122.86 points. Although it experienced a daily decline of 0.52%, it recorded an approximately 3.38% increase on a weekly basis. At Friday's close, 32 stocks rose while 63 stocks declined, indicating a profit realization pressure at the end of the day. Technically, the critical pivot support zone is between 10,280 and 10,900 points. Staying above this zone is vital for the continuation of the upward trend. The main resistance target on the upside is highlighted at the 11,800 point level. Let's also look at some local dynamics supporting the strength of the stock market. The share of TRY deposits in the banking system increased to 60.4%. The share of government domestic borrowing securities in the household debt instruments portfolio has reached 43.5%. This indicates the domestic investors' confidence in Turkish lira assets. Additionally, it is noteworthy that the entire increase of 0.7 billion in foreign currency accounts held by residents domestically comes from gold purchases. Lastly, while annual growth in card-based spending is around 56%, the insurance sector stands out with a 67% growth. Let's continue to evaluate Turkey's markets together, including the stock exchange, the US dollar, Turkish lira, bond yields, and CDS as key instruments. Let's analyze the complex relationship between the dollar-TRY exchange rate, bond yields, CDS premium, and central bank reserves, which collectively reflect Turkey's macro-financial stability. These indicators provide important clues about the success of the implemented monetary policy. Here are the closing data for the week. Dollar-TRY. The exchange rate closed on Friday, November 21st at 42.44. Bond market. The 10-year TRY bond yield closed at a high level of 30.30%. CDS. The 5-year CDS premium remains stable at 243.82 basis points. Central bank reserves. As of November 19th, the central bank's net position, excluding swaps, shows a surplus of $48 billion. This is a quite reasonable level, supporting the current exchange rate policy. To interpret these data as a whole, the controlled trend in the dollar-TRY, the high bond yields, and the low CDS triangle are the main pillars of the current monetary policy. The central bank keeps the Turkish lira attractive with high interest rates, while the declining risk premium also acts as an anchor for the exchange rate. Reserves are also strong enough to support this policy. However, this balance depends on the success of the fight against inflation and political stability. Expectations towards the 48 level by mid-2026 indicate the potential direction of the exchange rate if this balance is disrupted. After all these analyses, let's move to the economic calendar to see the important economic data that will influence the market trends next week. Let's review the critical economic data that the markets will focus on next week, and that has the potential to create volatility. In particular, the upcoming PCE data from the US will be the most important event of the week due to its decisive role in the Fed's interest rate decision. Since the PCE data is the Fed's primary inflation indicator, it will be closely watched by the markets. If this data differs from expectations, it could completely change the December interest rate cut expectations and cause sharp movements in the markets. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week. I wish you a profitable week.